Okay, thank you, David, and good morning, everyone, and welcome to the AltFinance Australasia Summit on behalf of Equifax, Australia's leading information services provider. At Equifax, we think we're pretty uniquely positioned, given that we see the vast majority of credit inquiries come through our platform. And in this morning's session, I'm going to give you some insights into things that we've identified through those inquiries to both our consumer and commercial credit bureaus over the last 3 years. As Noah suggested, actually, the data that we've reviewed suggests that there are a number of really exciting opportunities for many of you here today, but there is one specific risk that we will call out, and I think it actually ties in pretty well with one of the last questions that we heard in that last session. As the breadth of participation here today suggests, alternative finance really is a broad church of businesses with a wide variety of structures. It is, however, an increasingly important contributor to the financial services marketplace in Australia, with lending in 2016 of 609 million Australian dollars, according to the recent study by KPMG that, again, Noah alluded to a little earlier on. For the purposes of the analysis that we've undertaken and for our ongoing report into the alternative finance sector that we're going to be publishing on a quarterly basis, we've defined the alt finance market by reference to non-traditional funding sources, as well as a tendency to use and leverage leading digital technology and alternative data to both service customers, as well as create and evaluate insights into existing or potential customers for the purposes of underwriting them. Being a payday lender, debtor finance or factoring business does not in itself qualify a business in our mind to be an alternative finance provider, or at least not for the purposes of our analysis. Hopefully that definition won't offend anybody here today. We recognise that these industry groups in themselves do provide a number of other models that develop services and opportunities for consumers and businesses in the Australian marketplace and are in themselves important parts of our financial services eco-structure. In terms of highlights or summary, we've seen that lending to consumers makes up the largest and fastest growing part of the alternative finance customer segment. Whilst providers of the services are offered throughout the country, there is some variation in the geographic penetration, with Queensland leading the way to take up of your services. As many of us would assume, millennials show a higher propensity to utilise the services of an alternative finance provider. In the commercial sector, nearly all of the lending that we currently see through our bureau service is to SMEs. There's a broad demand across the vast majority of industries, although retail and accommodation services are seemingly more likely to be drawn to alternative finance. The alt finance market is, of course, maturing, with an increasing number of entities entering into the post-revenue stage, different terminology to that Noah used. They inquire with us at Equifax and are now working through the stages of producing efficient and scalable businesses. Consequently, when we index the volume of business we see to January 2015, the volume of consumer inquiries at the Bureau has continued to exponentially increase, and there are now more than 6 times the volumes of the January 2015 levels. The number of active lenders also contributing or inquiring of the Bureau has also increased at an even faster rate of knots. Demand for commercial loans continued its upward trajectory, which you can see on the bottom, the red graph on the left-hand side there, at a steady rate, and is now 4 times the level of the 2015 inquiry volume. Having said that, we do see that the rate of growth is slowing. Surprising given the relative overall penetration. We don't believe this suggests a lack of opportunity, but probably a lack of supply or marketing capacity. Whilst the use of alternative finance services has continuously increased over the past 3 years, the good news for you as an industry is, as I've just mentioned, that the proportion of the population using alternative finance is still low, at around about 3%, when compared to the active population of 44% of the populace. Whilst the penetration of alt finance users is low, there is significant variation across the country, with Queensland penetration a third higher than New South Wales and more than 50% higher than Victoria. Western Australia is an interesting case study in itself, with alternative finance seemingly able to capture a higher share of wallet than most of the other states. It has alt finance penetration similar to New South Wales, but overall lending inquiries lower than any other major state. No offence to Tasmania. This suggests that there's a significant, yet relatively easy opportunity for alt finance sector to grow, given that by simply increasing the penetration in each state to the same level as the penetration in Queensland would in itself increase lending by more than $1/3 billion per annum. So big opportunity with nothing more than equality across each of the different states. Whilst there is variation of take-up across the states, the difference in alt finance penetration between rural and metro postcodes is dramatic and represents a huge opportunity. Inner metro Sydney postcodes have 3 times the representation of the outer suburban and regional cousins. In Victoria, the trend is even more pronounced, with double-digit penetration in a number of urban postcodes. Given these rural and regional markets tend to be underserved by traditional lenders, this suggests that there's great opportunity to unlock significant more demand if you can find this audience and discover the right channel to engage them. We've already seen Queensland now has the highest levels of alternative finance lending, but it also has the highest recent growth rates compared to the more populous states. Again, the rate of growth in consumer inquiries across all of the major geographies has slowed. Whilst commercial lending growth is lower, it's more consistent, half on half and state by state. Given overall penetration's modest, and many markets are underserved, this suggests a supply-side challenge, or at least a difficulty in connecting with the undoubted latent demand. The challenge, obviously, is to recapture the growth rates from the last year. As I think we would all expect during this early phase of development of a new and exciting market, the young, who also happen to be the most underserved of markets, provide the vast majority of the consumer applications for alt finance loans. 54% of all applications come from customers under 35 years old. 62% of applications come from millennials, with a further 29% from Gen Xers. What's somewhat surprising is the proportion of applicants in the right-hand graph from each of the generation has not changed within the last 3 years. There's no evidence of a transition from the early adopter phase. Baby boomers and Gen X customers generally have less demand for credit, but given the recent tightening of credit standards by mainstream lenders, we might have expected an increase in take-up by older applicants. The younger population do tend to have higher demand for credit, so a focus on this segment makes sense, but there's probably a niche opportunity in the Gen X and baby boomer segment if you can accurately identify them as through a channel and also evaluate the risk of those segments who are still in the market for credit. One of the potentially worrying trends that we see is a deteriorating demographic quality of applicants. And whilst this, I'd be careful to make the point that this represents the applicant profile rather than the quality of the written book, it does suggest that there is potential for deteriorating credit quality and consequently higher losses, and probably higher operational costs as you subject more applicants to manual credit assessment or further data acquisition. The landscape segments for success stories, inner city professionals is reduced. These are typically high profile segments, and they're being replaced by segments of customers who traditionally have higher loss segments, such as the urban survivors, farming heartlands, and country battlers. Whilst there be a niche for players wishing to address these segments, reversing this trend and engaging higher quality applicants should really be a priority for all of those wishing to provide a direct alternative to mainstream banking. This deterioration in applicant quality demographics is replicated in a fall in the average Equifax supply score over the last 18 months. Alternative lenders' applicant base exhibits a 100-point lower average score than the total population. The variation we see in the general population between Queensland and the other eastern states is less profound in the alt finance base on the left-hand side, but is still significantly higher risk than the populations attracted by the traditional lenders. A further demonstration of this deterioration in applicant quality is the proportion of applicants who've had existing defaults, which has nearly doubled in the last 18 months and whose trend line shows a worrying increase. As you probably know, in 2018, in fact you all do know because Noah mentioned it earlier on, we will at least see the adoption of comprehensive credit reporting, as the big four banks are going to be compelled to supply repayment history information to the credit bureau. With the addition of account metadata and 24 months worth of account performance through the repayment history information, early adopters will have far greater insight into their potential customers and consequently be able to make better decisions all the way through the credit life cycle. In our New Zealand rollout of comprehensive reporting, which is slightly in advance of that in Australia, we saw at the time when there was a 50% take-up of CCR that two of the major lenders in New Zealand were able to increase their personal loans origination by 10 and 12% respectively for the same amount of marketing spend and the same amount of bad debt. The deeper insight into the customers allowed them to cherry pick or create the swap set of customers that allowed them to get deeper insight into their customers. I guess also more worryingly for those who did not participate in comprehensive reporting as an early adopter, those businesses actually saw an adverse selection effect as well. So as the early adopters of CCR were able to write the business for those customers and take them off of the market, there was a deterioration of around about 16% in the credit quality of the customers that were being booked by those who were not participating in CCR. This, as Noah alluded to earlier on, is a key enabler of alternative finance business in both the UK and the US. You can think of it as alternative data if you want to, but pretty much mainstream opportunity in those countries and ought to be here in Australia pretty soon now that everybody is trying to chase their tails to catch up given the mandate for the big four banks. We've already seen that the commercial alternative credit inquiries are significantly outgrowing the total market, which in itself, you can see on the left-hand graph there, has actually shrunk in recent months. Unlike the consumer segment, credit quality is improving as volume improves. The industry sectors that apply for credit via alternative finance is generally similar to the total population. The alt finance being on the red on the left-hand side and total population on the right-hand side. As you can see, there's a significant overrepresentation within retailers and accommodation and food services providers, with converse underrepresentation in financial services and construction industries. Given the challenges facing these two particular industries, it would seem likely fertile ground for alternative finance providers in the commercial space if you have the data and the decision systems that can help you accurately evaluate their risk. In the consumer segment, we saw that millennials were more likely to use alt finance than the older generations. In the commercial business, very young businesses, so those less than a year old, would appear to be still drawn to traditional lenders, whereas the bulk of your applicants are coming from young but not brand new businesses. The very well-established group of businesses that are 20 years older or more would seem not to have heard of alternative finance. Naturally, these businesses tend to be more financially stable and better served by mainstream lenders. Maybe, again, there's an entirely different value proposition in there for some of you. As I mentioned in the summary, the vast majority of commercial lending applicants to alt finance providers comes from SMEs, with nearly 99% of applicants coming from that segment, compared to 89% for the general lender portfolio. In previous surveys that we've undertaken, the complexity of business structures, the provision of banking relationship managers is seen as a differentiator for those customers. Whilst technology and data-driven insights can help provide better offers and improve service, the complexity and the expectation of high personal service makes this more challenging niche proposition for alternative finance lenders. Again, a differentiated value proposition would seem to be required. One of the recent regulatory mooted concepts that I think actually may also change this position is the APRA's consultation process on credit capital, which was released on the 14th of February. earlier this year, which alluded to changes in the way capital is evaluated and reported for SMEs. But the quid pro quo for potential increased capital in that particular segment is the opening up of automated lending opportunities for that group as well. So there's certainly an opportunity there to think about lending into larger businesses and for larger amounts of credit. As I think has been seen in probably the last two presentations, alternative lending's continued its tremendous run of growth. As I've hopefully demonstrated this morning, there's significant variation in the age demographic, the penetration by state, the landscape segments, and the time in business. That all suggests that there is plenty of further plenty of fertile ground for alt lenders to continue to grow your businesses. The maturing of many of your businesses and the entry into the marketplace has helped to continue the development of the market, although it's clear that whether by accident or design, the profile of the applicants has significantly deteriorated in recent quarters. Attracting high-quality applicants, or alternatively developing state-of-the-art risk-based pricing capabilities and higher leverage of digital data such as comprehensive credit reporting or open banking data and ID and fraud prevention services will become a prerequisite to ongoing business success. And naturally, of course, Equifax are here to help. Thank you very much. David.
Am I taking a few questions? Sure. Okay, we have a few questions to ask. So remember to go to events.altfi.com. Let's get a couple more up there. But I'll ask you a straightforward question, Mike, first. Are the alternative finance industry playing with fire? Are they effectively borrowing to the wrong set of people? Or lending to the wrong set of people.
Look, I think, again, Noah alluded to this earlier on. I think that there will be players who do get it wrong. They'll miss the mark. They won't be able to necessarily attract the right through-the-door population. You've got to have you've got to think of a harmonised proposition all the way from where are we putting our advertising, how are we attracting a population, and are we attracting the population that we've developed our products and services for? You don't want to attract a margin, near prime segment if you've developed a low-cost service proposition for prime proposition. You'll be either declining too many people, or you'll be taking too many people on and suffering the bad debt risk as a result. So undoubtedly, I think some people will fall into that trap of either creating the wrong value proposition and going after the wrong customers, or not developing a good enough capability to evaluate the risk of the applicant profile, or even managing the risk through account management and collections processes. I am, however, very encouraged by the work that we do with with most of, if not all of, the players in the room today, where we do see a deep understanding of what it is people need to develop to create a good capability, and they're largely putting that capability there in advance of needing it, which is good to see. Obviously, I think comprehensive credit reporting and open banking data, depending on when that arrives, could obviously create some more significant challenges for businesses. So it'll be a mix.
Absolutely. So if anybody's also got one question you don't want to put through the machine, please put your hand up and my colleague over there will race over to you. But in the meantime, we have got one question. Oh, actually two questions. Do you want to take them both, Mike?
Sure. Okay, so the first one, CCR market share in loans. That is an interesting question for me. So believe it or not, because I'm clearly very youthful, 30 years ago, just over 30 years ago, I think it was the 13th of December 1987, I started in the industry in the UK. And the first thing they did when I arrived was said, we've been sending data to a credit bureau for a couple of years now. Bank time we started using it, over to you. So my journey with CCR actually started 30 years ago. The thing we saw in the UK was that the large lenders, the big four banks and the Council of Mortgage Lenders, did not participate in comprehensive reporting or positive reporting as it's called in the UK, didn't participate in CCR from the beginning. And what happened in that environment was that you had the perfect storm of deregulation, so building societies could start offering more products, so transaction accounts, credit cards, etc. We saw that deregulation. We saw the comprehensive credit reporting coming on board. We saw the development of wholesale lending platforms to fund books. And that consequently brought in a lot of monoline providers. So in the UK, credit card market share slewed very dramatically towards alternative providers. Now, in those days, it was monoline credit card providers, monoline personal loans providers, not necessarily getting alternative funding sources in the same way. So in that environment, we saw, it was more than 50% of credit card originations came from those alternative sources. I think here, because the mandate to the banks, we won't see that being as dramatic, but I do think that alternative lenders could capture 20% market share pretty reasonably if there is a clear focus on delivering the value propositions that customers are looking for and picking off the segments of customers that are either underserved or not valued or not within the risk appetite of the mainstream lenders.
Next question.
Yeah, okay. So look, I think it is a good question. We've had a tremendously good run here in Australia in terms of credit performance. I think one of the things that we've noticed within our wider customer base is people beginning to recognising that we are somewhere near the bottom of the credit cycle. There's been a tremendous amount of investment in new collections systems. A number of large providers have tightened up a number of their credit capabilities. There's also been a major focus on hardship management or identification and management as well. So one of the things I think we have seen is that people have actually proactively started to manage some of the challenge that we think will be coming along. Having said that, we haven't had any real shock to the system, so unemployment rates have remained relatively stable. Interest rates are extraordinarily low and benign. The last time we had a recession in Australia, of course, the debt-to-income ratio was 80%. It's now 190%. And in fact, when it was 60% shortly before the last recession. That recession, we saw interest rates of 17.5%. So if we just imagine, the repayment difficulties people would have with 190% debt to income and 17% interest rates. Probably not a scenario that's going to occur given some of the more macro or global macroeconomic situations, but nevertheless, I think we still are on the way driving towards that in that direction.
One last question, and I'll do a quick follow-on question from that whilst you think about that one. Your colleagues in America have noticed America's doing very well, powering ahead, but even they've started noticing some isolated areas of credit defaults beginning to creep up. Quite often it's geographically based.
Yep.
Quite often
same here.
Yeah, absolutely, exactly what it's come to. And it's quite often geographic based or particular socioeconomic groups, so that it's very, very particular. But they have noticed the first signs of the turn. Yep. Have you started seeing that in Australia?
Yeah, absolutely. So I think it's pretty well understood that with the slowdown in the mining boom, that those areas, well, certainly areas of single source mining towns, it's actually catastrophic. Luckily, they're fairly small geographic groups, but more broadly, some of the centres that service those mines, so ports in particular, are also suffering. So we're already beginning to see that, and then that's also then having a knock-on consequence into, more broadly into regional areas within those mining estates.
So at the moment, it's more regionally specific.
Yes.
Yeah. It's not any broad national group that you're noticing that's beginning to suffer stress.
No.
Last question. With applications of ML and social data, you feel the sources will provide significantly better assessments of a person's creditworthiness. This, of course, exposes the classic question is, with more data and with better data, more granular data, are you actually going to be able to make better decisions? Yeah.
So look, I think that's absolutely the case. From my perspective, comprehensive credit reporting is an alternative data source. It's a new thing. It ticks the 4 V's or 5 V's of value for data. So the volume of it's going to be big. The veracity of it is very high because you get it from regulated entities in banks. The velocity of it's pretty good. It's monthly data. The variety. Well, the variety will depend on which bureau you go to, but of course we've got a very broad base of data across all of the financial services sector, telcos, utilities, alternative finance lenders. So that as a source, I think, is very strong. When I think any additional data source, is likely to have some impact on your ability to make better decisions because it will have some level of information value. The thing that people need to be very careful of or wary of when they're thinking about social data, as an example, is it easy to manipulate that data by either the consumer or a third party? Is it actually stable information? So I know in a previous actually in an ARCA breakfast series that I spoke at on one occasion, someone was explaining it's really, social media data is really great because 5 years ago, only 20% of people looked at Facebook once every, the numbers won't be right, but 20% of people looked at Facebook data every day. Now it's 50% of people. To me, that's actually a problem and a challenge with social media data in that the nature of it and the meaning of it is changing. It isn't that there's suddenly 2.5 times as many people with the same profile that use their data once a year. It's that more people are using it. Therefore, the nature and the predictive content in that data has changed dramatically.
Okay, I think we've run out of time. Put your hands together for Mike from Equifax. Thank you very much, Mike.